Therefore, I say that you take someone's asset, you use it, then you pay something, what we call lease rentals, at the end of the year. At the end of the year, or whichever, according to the contract, you pay the lease rentals according to the contract. Then we say that under IFRS 16, we are going to recognize what we call the right of use. Remember, I gave an example of IAS 17. Leases previously was under IAS 17. And under IAS 17, on the part of the lessee, we were recognizing what we call operating lease, and finance lease, We were categorizing a lease into operating lease and finance lease, but now the provisions changed. IFRS 16 came in, and now they changed how you recognize leases on the side of the lessee. The lessee is the user of the asset, the borrower of the asset. On the side, we are recognizing today, we said we recognize the right of use, and the lease liability, And we defined in our previous lesson, we said what is the lease liability, and we said lease liability is the present value of minimum lease payments. And I said that, for example, the asset cost to the owner of the asset is 200 million. I, as the lessee, I will not recognize 200 million as the lessee. The borrower of the asset, I will not recognize 200 million. I will But what I will do, I will look for the present value of minimum lease payment. For example, I'm paying 1 million annually for 10 years. Therefore, we say that I will discount this. I will discount this 1 minus into 1 plus r raised to negative n divided by r. I discount that to the present value, then maybe I get something like 50 million. Therefore, that 50 million now becomes the lease liability. Therefore, we say the lease liability is the present value of minimum lease payments over the lease period. What I'm going to pay over the lease period, it becomes the lease liability. Then we discussed and said also what constitutes the right of use and what constitutes the lease liability. Now, remember, we say that in a lease, we are going to recognize the right of use asset and the lease liability. Therefore, how shall we recognize on initial recognition? Initial recognition means the moment I enter into contract with you, like my good friend Joanne, I enter into contract that I want to take your asset, I use it. Therefore, there is the value I'm going to put in my records as the liability or as the value. Therefore, that is what we call on initial recognition. At the moment we agree which value am I recognizing from this asset, that one what we call initial recognition. And we say that on initial recognition, the right of use will be measured at the lease liability. It will be measured at the amount of lease liability, like this is 50 million, plus any initial direct cost incurred by the lessee. And what are these initial direct costs? We said, number one, you take first the lease liability, then you add any direct cost that the lessee is paying before commencement, then any dismantling cost. Dismantling cost is, for example, is a big asset, you need to transport it. Therefore, you dismantle the asset, then you transport it, you come and assemble all those costs you are incurring. It will be part of the right of use. Then any payment less incentive before the commencement. Any payment less incentive before the commencement. Any payment means, for example, you have a policy as the owner of the asset that before somebody takes my asset, he needs to give me 1 million. That is any payment. Therefore, out of that, because I'm your habitual customer, I'm your usual customer, when I come to take your asset, you say you are giving me a discount of 20%. Therefore, that discount, we subtract that discount from that, what I'm required to pay. We subtract, then we get what we recognize as the right of use. Then we also said what constitutes the lease liability on initial recognition. On initial recognition, what will constitute the lease liability? We said, number one, fixed payment less any incentive. Fixed payment less any incentives. Number two, any variable cost adjusted by a consumer index in future. Any variable cost adjusted by consumer index in the future. Consumer index are things like inflation in the market, interest rates that affect the economy. Therefore, those are the consumer index, increase in the interest rate in the market. Then we said also any expected residual value that is guaranteed. Expected residual value is, for example, the useful life of the asset is 20 years. I'm taking the asset for 20 years. Then after that, there will be a very minimum amount that will remain. Therefore, I assure you that at the end of the lease term, you are going to take that value. You are going to take that asset. Therefore, you know that there will be 1 million remaining. Therefore, that 1 million will be part of the lease liability. It will form part of the lease liability. Then we also said any penalty on terminating the contract. For example, I'm taking the asset for 10 years, but after 2 years, I return your asset. Therefore, I have not honored the contract. Therefore, that terminating the contract before maturity, it will attract the penalty. Therefore, that penalty will become part of the liability, Fini Omare, you say, Mwalimu, unmute your mic. But I'm unmuted. Anybody, I can see Immaculate, I can hear. Maybe Vincent, you check on your network because it's only you who is complaining about hearing me. I'm on. Therefore, maybe you should check from his side. Maybe Pini, you can check from your side. Kindly, you can check from your side so that you can be with us together. You can be with us. You are clear. Thank you very much. Very clear. Thank you very much. Therefore, you can check from your side so that we can move together. Therefore, I was saying what constitutes the lease liability, then terminating the contract will attract that amount. Then any exercise price in the option, we say that any exercise price, for example, I'm taking the asset for 5 years, then the useful life of the asset is 20 years. Therefore, after 5 years, the asset still has the huge amount of money, the value is still high. But I agree that I will take the asset. I will exercise that option to take the asset from you. Therefore, that exercise price will be the part of lease liability. Therefore, that is where we are. That is where we are. That is where we are. I believe we discussed up to that point. Then we want to continue from there. We want to continue from there, and we are going to subsequent measurement. Subsequent measurement. We go to subsequent measurement. Subsequent measurement. Subsequent measurement. Subsequent. After initial recognition, we go to subsequent measurement. Those who are with us, you write subsequent measurement. Subsequent measurement of the lease. Subsequent measurement. Then we say that subsequent measurement means like this. Now, after I have recognized like 50 million from this asset on initial recognition, I have recognized 50 million. Will I recognize 50 million in my books up to 20 years to come? Definitely no. At the year end, I need to recognize this asset in the books. And the other year, I need to recognize it. Therefore, which is the value that am I going to recognize at the end of each year? That is what we call subsequent measurement. Subsequent measurement means at the end of each year, how am I going to recognize the asset in my books as the lessee on subsequent measurement? Therefore, subsequent measurement, we start with the right of use. You say the right of use is depreciated. The right of use is depreciated. You say the right of use is depreciated on straight line basis, on straight line basis. On subsequent measurement, the right of use is depreciated on straight line basis, on straight line basis. Therefore, straight line means, for example, I'm taking the asset for 10 years. The value on initial recognition is 50. Therefore, straight line, I divide by 10. Therefore, each year, I'm recognizing depreciation of 5 million. That is what we mean by straight line, cost over the useful life of the asset. Cost over the useful life of the asset. Then we continue to say, however, the useful life of depreciation is the area of. You say, however, the useful life of depreciation, the useful life of depreciation is the area of. However, the useful life of depreciation is the area of, however, the useful life of depreciation is the area of number A, economic useful life of the asset, economic useful life of the asset. Number B, the lease term. Number B, the lease term. How I'm going to depreciate this asset? I'm going to use years of depreciation, the area of. Number A, we are saying the economic useful life. Number B, the lease term. Like, for example, my good friends, the asset useful life is 20 years. This is the useful life. Useful life is 20 years. For me, I'm taking the asset for 10 years. For 10 years. This is the lease term. This term is 10 years. This term is 10 years. Therefore, if I want to depreciate this value on initial recognition, I will use the area of Nikani Kidogo. Which one is less years? Therefore, the area of is this 10. I will use 10. I will use 10. Therefore, my depreciation each year will be 5 years. Therefore, we are saying, however, the useful life of depreciation is the area of number A, economic useful life of the asset. Economic useful life, there is the lifespan of the asset. Then the lease term, how long am I taking the asset? That is the lease term. How long am I taking the asset? That is the lease term. Then you put a note and say, if the title will be transferred at the end of the lease term, you say not. If the title will be transferred at the end of the lease term, if the title, not, or NB, if the title will be transferred at the end of the lease term, at the end of the lease term, if the title will be transferred at the end of the lease term, then depreciate using the economic useful life. Then depreciate using the economic useful life. Depreciate using the economic useful life. Now, what do I mean when I say if the title will be transferred at the end of the lease term, then depreciate using the economic useful life? What do I mean? What do I mean? What do I mean is that, for example, we agree that I'm taking the asset for 10 years for use on a lease. But after 10 years, I will take the asset, I will purchase the asset to be mine. I will buy that asset. Therefore, the title will be transferred to me. I will buy that asset. Therefore, if there is that clause that I will buy the asset, when I want to depreciate, I will depreciate using what? I will depreciate using the economic useful life. Like the example I have given you, 20 and 10. Economic useful life is 20. Therefore, I will depreciate that asset using 20. If the title will be transferred to the user of the asset at the end of the lease term. Any questions so far? Remember, as I indicated, we shall be finishing our class very early because we are having Thanksgiving for the good performance of the last semester, including advanced financial reporting. It was awesome. It was done very well. Therefore, we are celebrating. We have a Thanksgiving at exactly 8 p.m. I believe you will log in and be part of this celebration. Thanksgiving, we pray, we thank God for that. Therefore, we shall be finishing our class at 7:30 to prepare for the Thanksgiving. We prepare for the Thanksgiving ceremony. Maybe you are in the intermediate and you are with us. You are part of this celebration. The link is available. You will join us. Then we celebrate together for the good performance. Therefore, kuna food. Because you are in your house, you will just buy a small funder in your house, and we celebrate together. But we are organizing for a ceremony where we shall come together and celebrate together. But for today, we just want to thank God. We just want to thank God online. Remember, our business is online, but we shall organize for the ceremony. It will be there. Like last semester, we had a very big ceremony. Those who came, you saw what happened. Therefore, we are organizing another one. Another ceremony will come. For this good performance, we must celebrate and thank God for that. Therefore, the food will be in that ceremony. But today, just buy yourself a small funder, a small one. As we celebrate together, you sip. As we celebrate together, you sip, because we are online. We are online. Therefore, we are very happy as RCM for the work. We are very happy. We are very happy because almost 85% or 90% of the students out of 200, they made it. And they are now rejoicing. Almost 90% out of 200. It was not a joke. It was not a joke. Therefore, we shall also celebrate you come in September. We shall celebrate you because you know we are going to make it. We are going to make it. We shall celebrate a lot. Thank you very much. Thank you very much. Therefore, stay with us. The only medicine to make it is to stay, to be consistent in class, as I already said. The only medicine to be consistent, because everything we are doing, it will be tested. Don't assume that this is a small topic. This one is a big topic. I must know. Everything we are doing, it will be tested. Therefore, stay tuned, stay with us in every angle. Then you will have also to celebrate. Remember, CASNEP needs a serious person like you. Needs a very serious person like you. Thank you very much. Therefore, as I said today, we shall be finishing at 7:30 to prepare for that online Thanksgiving. The link is available. You will log in. We thank God together. Thank you very much. Now, let's continue. Now, that is the right of use on subsequent measurement. The right of use, we have said, we depreciate. We depreciate on straight line. We depreciate on straight line. Then, what about the lease liability? How do we measure lease liability on subsequent measurement? Lease liability on subsequent measurement. How do we measure the lease liability? How do we measure the lease liability? Lease liability. Subsequent measurement. How do we measure lease liability? That is subsequent measurement. We say this is carried at amortized cost. This is carried at amortized cost. At amortized cost. The lease liability is carried at amortized cost. It is carried at amortized what? Cost. Then you continue to say, the way amortization is done, the way amortization is done, the way amortization is done is dependent on the way amortization is done is dependent on when payments are done. Is dependent on when payments are done. Is dependent on when payments are done. On when payments are done. I'm going to explain that. Then you say there are two types of payment. 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 Two types of payment, i.e. at the start of the year, i.e. at the start of the year, at the start of the year, at the start of the year, in bracket you say advance. In bracket you say advance, and at the end, of the year, and at the end of the year, in bracket you say arrears. You say arrears. In bracket you say arrears. In bracket you say arrears. In bracket you say arrears. Therefore, what am I saying there? I'm saying there are two times. How we prepare the amortization schedule, it will depend on how we are making payment. Because if I have the lease, then I will be paying the lease rentals. Therefore, when am I making the lease rentals? Is it at the beginning of the year or at the end of the year? Therefore, sometimes the moment we enter into contract, I need to pay the lease rental. Therefore, we start the year in January, I pay 1 million. I finish that business. Or I wait until the year end. I wait until the year end. It's just like you have a loan. The simple explanation that you have a loan, this loan attracts interest. Therefore, we can agree that I give you the loan of 1 million, the interest of 100 you are required to pay every month. Therefore, this interest you pay either at the beginning of the month or you wait, you pay in arrears at the end of the month. That is what we are explaining. Therefore, the way we are going to prepare the amortization schedule, will depend, are we paying in advance or we are paying at the year end in arrears. Therefore, that is how we are going to prepare the amortization schedule. Therefore, let's look at the format of the amortization schedule. How do we prepare the amortization schedule when we want to recognize the lease liability on subsequent measurement? Amortization schedule. Amortization schedule. Amortization schedule. Let's begin with when payments are made in advance. When we are making payment in advance, how do we prepare the amortization schedule when sorry for my Vincent, I rest before you copied. Sorry for that, but I will be waiting. I'll be giving you time in subsequent erasing. I will be giving you time. Therefore, in advance, if it is in advance, amortization schedule, how do we prepare that amortization schedule when payments are made in advance? This is how we prepare amortization schedule. I will say year, for example, year. I say year. Then balance brought down, principal balance brought down. That is what I have at the beginning as the value at the beginning of the year. Then I make installment. I make installment because I'm making installment at the beginning of the year. Out of the principal balance, I make installment. Then I get what I call capital balance. Capital balance. We have what we call capital balance. Then out of this capital balance, I come and charge interest. I charge interest on the capital balance. Then I get balance carried down at the end. I get balance carried down at the end. I underline, don't make it too long. Just one line like this, just one line. It's just a format. Therefore, don't make something too long. Make something too long. Therefore, here, we start like in year one. Our year is year one. Principal balance, let me put it A. That is my principal balance. I put there A. Then installment, I make it B. Installment is B. Installment, I make it B. Installment, let me make it B. I'm paying out, installment paid. You can say installment paid. You are paying out, installment paid. Then I get capital balance, let me call it C, capital balance. Let me call it C. Then I charge interest based on the capital balance. That is, let me call it D. Let me call it D. D for dog, capital interest. Then I get my balance carried down, which is E. Therefore, if I want to amortize, how am I going to get these values? I will say C, this capital balance, equals to A minus B. A, I take A, this is the installment, like for example, the value of the asset is 200. Then out of that, I'm paying 1 million. That is the installment. Money I'm paying out as lease rentals. Then C, what is remaining after I have paid installment? C equals to A minus what? B. Then E, which is the balance carried down, equals to C plus D. C plus D. Now remember, this interest, I'm charging on the capital balance. Therefore, for example, this one is 100. This one is 10%, for example. I'm just using an example. Don't ask me where am I getting 110%. I'm just saying an example. This is 100. This is 10%. Therefore, the interest will be 10. Therefore, for me to get E, it will be 100 plus this one. Therefore, it will be 110. Capital balance plus the interest. But remember, the interest, we charge it on capital balance. Therefore, this is the principal balance, installment. Then we continue like that. Therefore, C is A minus B. Then E is C plus D. That is if installments are made in advance, because I cannot charge this interest on the installment because I'm paying in January. For example, I'm ending the year in December. I'm charging the interest on January. I'm paying the installment on January. Therefore, this installment I'm paying will not attract interest. That is why I'm subtracting before I get the capital balance. Therefore, it's like reducing balance. Yes, it's like reducing balance because I'm reducing the principal balance by the installment. Therefore, that is if the payments are done in advance. Now, let's look at if payments are done in arrears at the end of the year. How do we prepare the amortization schedule? How do we prepare the amortization schedule. Hassan, you say, Mwalimu, can we break for prayers? I can give you 5 minutes for prayers because I know we are the beneficiary. You are going to pray for us as comrades. Therefore, 5 minutes break for prayers. Hassan has requested 5 minutes for prayers. Then we continue. We continue 5 minutes strictly. Okay, now let's look at the schedule when payments are made in arrears. Schedule, how it looks like when payments are made in arrears. Payments are made in arrears. Arrears. How will the schedule look like when payments are made in arrears? Therefore, here we say here, a principal balance, Then we come to interest in the lease. Then we come to installment. Then balance carried down. Balance carried down. Don't make it too long, just one line. It's just the format, just the format. Okay, like here in year 1, my principal balance, let me put A. Principal balance, let me put A. Interest, let me put B. This interest we charge on this principal balance, the interest implicit in the lease. How much are we charging at the market rate, the interest in the lease? We charge it on the principal balance. Then we come to installment paid. Installment paid, let me call it C. Installment paid, this one we call it C. Then we come to balance at the end, we call it D. We call it D. The balance at the end, we call it what? D. Therefore, out of this, how do I get D? D equals to A plus B minus C. This D, balance carried down at the end, which will be the lease liability. This one will be the lease liability at the end. What I'm going to report at the end of the year as my lease liability, it is D equals to A, principal balance, minus plus the interest and the interest we charge on principal balance. Then I less the installment, I get D. That is how we do the amortization schedule when payments are made at the end of the year. When payments are made, which means the principal balance will totally attract interest. Will attract interest in total. But in the first schedule, the interest was charged after subtracting the installment. But here, this installment will also attract what? Interest, because the installment is in the principal balance. That is what you do. That is what you do when payments are made in arrears. Therefore, what goes to the income statement? What goes to the income statement? What goes to the income statement? To the profit or loss? When I have the lease, what goes to the profit or loss? What goes to the profit or loss? Number A, the interest charge. Interest charge is this interest charge, interest implicit. Then number B, depreciation. Number B, depreciation. Number B, what goes to the income statement or profit or loss as a lease cost, as a lease, is interest. This interest, then we have depreciation, because we said the right of use will be depreciated. The right of use will be depreciated. Then, let me now listen to this very carefully. When payments are made at the end of the year, examiner will ask you for year 1. Listen very carefully. when payments are made at the end of the year, examiner will ask you year one. Like, for example, prepare the financial statement for year 2023. That only 1 year. But if payments are made in arrears, you are going to prepare for 2 years. Like in this case, if payments are made in arrears like this one, our examiner wanted this year one, 2023, but I will have to add an extra year, 2024. 2024, let me say A, B, C, D. Therefore, I will prepare for 2 years. That is if when payments are made in arrears, I will prepare for 2 years. These 2 years, remember, in a lease, I'm required to separate. In a lease, I'm required to separate between current liability and a long-term liability. Current liability and non-current. That is long-term liability and short-term liability. Therefore, when I prepare the 2 years, like for example, let me say the year one, this was 20. Let me assume it was 20,000, year one. Then year two, let me assume it is 18,000. Let me assume it is 18,000. Let me assume it is 18,000. Therefore, I'm saying if payments are made in arrears, you will have to prepare for 2 years. Even if the examiner wanted year one, you add another year two. That's what I'm saying. What is the purpose? Is to separate between the long-term liability and the short-term liability in the lease. Therefore, here, the one for year two, this one is non-current liability. Non-current liability in the lease. Then the difference between year one and two, the difference which is 2,000, the difference which is 2,000, that is the current liability in the lease. Current liability in the lease. That is the current liability in the lease. Therefore, I'm saying, and I repeat, if the examiner wants you to prepare a amortization schedule, payments are made in arrears. You always prepare for the subsequent year. Examiner wanted year one, you add another year. What is the purpose? You are required to separate between the current liability and the non-current liability. Therefore, the liability for year two, the balance carried down for year two, will be the non-current liability for year one. Then the difference between year one and two, it becomes current liability, like what I have done here, current liability. But if payments are made in advance, if payments are made in advance, if examiner wants year one, you only prepare for that year one. If payments are made in advance, I have already shown you the schedule. You can check there. If payments are made in advance, examiner wants year one, you prepare for only year one. Then the installment you are paying, becomes the current liability. Then the balance at the end, that number E, the balance at the end becomes our non-current liability. I believe I'm clear. If payments are made in advance, the installment we are paying is not, we report it in the balance sheet as non-current, as current liability, sorry. Then the balance number E, the balance at the end, balance carried down, we report it as non-current liability in that matter. Thank you very much for understanding that concept there. Now we want to look at like a small question. Like a small question, we are just writing like a small question so that we see how we do a lease. You say like this, A limited, you say A limited, entered into 20 years lease of building. A limited entered into 20 years lease of building. A limited entered into 20 years lease of building. 20 years lease of building with an option to extend for a further 5 years. I said A limited entered into 20 years lease of a building with an option to extend for a further 5 years. For a further 5 years. for a further 5 years. Lease payment of shillings 80,000 are payable. Lease payment of shillings 80,000 are paid during the initial term. Lease payment of shillings 80,000, lease payment of shillings 80,000 are paid per year in arrears, are paid per year in arrears. Lease payment of shillings 80,000 are paid per year in arrears, during the initial term. Shillings 80,000 are paid per year in arrears during the initial term, and shillings 11,000 per year during the optional period. I said, I will repeat. A limited entered into 20 years lease of building with an option to extend for a further 5 years. Lease payment of shillings 80,000 per year are paid at the end of the year, in arrears, are paid per year in arrears during the initial term, and shillings 11,000 per year during the optional period. To obtain the lease, you continue. To obtain the lease, a limited incurred initial direct cost. To obtain the lease, a limited incurred initial direct cost. Initial direct cost of shillings 25,000. Initial direct cost of shillings 25,000. At the commencement date, a limited concluded that it is not reasonable to extend the lease. At the commencement date, a limited concluded that it is not reasonable to extend the lease. At the commencement date, a limited concluded that it is not reasonable to extend the lease. The interest rate implicit in the lease is 6%. The interest rate implicit in the lease is 6%. Required. Show how A Limited will account for the above transaction. Required. Show how A Limited will account for the above transaction. Required. Show how A Limited will account for the above transaction. Required. Show how A Limited will account for the above transaction. Required. Show how A Limited will account for the above transaction. Therefore, let's quickly in a very few minutes, look at this small question. Let's very quickly, because we said we are finishing our class very early because of the Thanksgiving. For you guys who have been thus, we have met you, you have made us proud. Therefore, we need to celebrate you by Thanksgiving, Therefore, here, analysis. Let's do the analysis. A limited is the lessee. A limited is the lessee. Is the lessee of the asset, is A limited. Then lease term on initial it was 20 years. Although we are not going to extend for a further 5 years because we saw it's not reasonable. Lease term is 5 years. Extension is 5 years. But are we going to extend? We saw that it is not reasonable. It is not reasonable. Interest rate is 6%. Interest rate is 6%. Annual lease payment is shillings 80,000. 80,000 annual lease payment during the initial term, of which that is what we are going to do it. Payable at the year end. Year end means in arrears. Payable in arrears. Payable at the year end, which is in arrears. Then we also have initial direct cost. Initial direct cost, which equals to 25,000. Initial direct cost, which equals to 25,000. Initial direct cost is 25,000. Therefore required, show how A limited will account for the above lease transaction, Therefore, what we do, the first thing in our list, we say on initial recognition, what do we say on initial recognition? You debit the right of use, then I credit lease liability. That is what we said on initial recognition. That is where the beginning point of our lease, initial recognition. How do I do it? Debit the lease, debit the right of use, credit the lease liability. Then, how do I get the lease liability? Lease liability equals to a present value of minimum lease payment. Present value of the minimum lease payment. How do I get the present value of minimum lease payment? I discount whatever I'm paying annually to the present value. Therefore, lease liability equals to, I will take 80,000, that is what I'm paying annually in the initial term, into 1 minus into 1 plus R raised to negative N divided by R. Now it will be 80,000 into 1 minus into 1 plus 0.06. Our interest rate is 6%, which is 0.06. I close, raised to negative 20. Raised to negative 20, that is the N, the lease term, then divided by 0.06. I discount like that. That is how we discount annuity to get the present value of an annuity. I will take 1 plus R, 1 into 1 plus R raised to negative N divided by R. That is how we do it. I have even done it here. 1 minus into bracket, 1 plus 0.0. Therefore, first, if I want to put it on a calculator, I know many of you forgot the FM. You take 1 plus 0.06, you raise to negative 20 to negative 20, then you divide by 0.06, you will say 1 minus. First of all, I will take 1.006 like that. Then I raise to negative 20. Then I say 1 minus answer, 1 minus what I'm getting here. Then answer divided by 0.06. Answer divided by 0.06. Titus, you say 11,499. Enoch, I believe you are very correct. 917,592. Enoch, I believe you are very correct. You are very correct. You are very correct. Anyone else? 917. Thank you very much. 917,592. Therefore, our present value, according to what I'm seeing there, is 917,592. That is our lease liability. Lease liability. As you can see, 93 point. Therefore, we can put 4. Let's round off to 4. 917,594. I'm rounding off because I'm seeing many of you 93.7, 93.7. Therefore, I'm rounding off. I'm rounding off to 917,594. That is our present value, which is the lease liability. Therefore, the lease liability equals to 917,594. That is on initial recognition. On initial what? Recognition. But will this be the right of use? Sometimes it can be the right of use, but sometimes it cannot be the right of use. Why? We check if we have any other costs that make up the right of what? Use. Therefore, my right of use, the lease liability is that one, but the right of use equals to lease liability plus any initial cost. Remember, we discussed any initial cost that is incurred by the lessee, like any direct cost, any dismantling cost. Therefore, remember, in this one, we add any direct cost, The right of use, therefore, I will take 917,594 plus 25,000. 25,000 because I have initial direct cost. We said, how do we get the right of use? Lease liability plus any initial direct cost incurred by the lessee, like direct cost, dismantling cost, all those costs we mentioned. Therefore, here we are going to add. Therefore, how much will be our right of use? Right of use. This one is the lease liability. But how much shall we recognize as the right of use? 942,594. 942,594. Thank you very much. That is the right of use asset on initial recognition. On initial recognition, that is what we do. On initial, you take the lease liability, you add any cost that we highlighted. If you go to our notes, already we highlighted. Therefore, that is on initial recognition. I have the lease liability, I have the right of use. I go to subsequent measurement. Therefore, my subsequent measurement, we said the right of use is depreciated. The right of use is depreciated, The right of use is depreciated. Therefore, for me to report this 942 at the year end, I'm going to depreciate it. Shouldn't we credit the initial payment to balance? Yes, we are adding the initial payment. This initial payment, initial direct cost payment, we are adding because it's part of the cost of the asset. It's part of the cost of the asset. We are adding to it. We add to the lease liability to increase what will be the right of use. The cost of the asset that we are going to recognize, we add those costs. We add those costs. Therefore, on subsequent measurement, we said the right of use is depreciated. The right of use is depreciated. Therefore, how do I depreciate? I'm going to take 942,594 divided by the lease term, which is 20 years, The lease term, which is 20 years. Therefore, how much is the depreciation I'm going to report? How much is what will be the journal entry after that? Now, the journal entry, if you want us to do the journal entry, number one, journal entry number one, our journal entry, number one journal entry will be debit, right of use with 917,594. Then I credit lease liability with 917,594. That is on initial recognition. Then number two, I have the direct cost, initial direct cost. With the initial direct cost, what am I going to do? I'm going to debit the right of use, which means I will increase the right of use with 25,000. Then I credit cash or bank. Because I'm paying 25,000. That is why I'm taking ROU. That is why I'm taking ROU equals to 917,594 plus 25. Because on initial recognition, I debit right of use, I credit cash or bank. That is our journal entry for those who are asking the journal entries. Therefore, here you are saying it is 47,130. The 130, let's say 47,130. 47,130. That is the depreciation we charge it to income statement. Therefore, our ROU at the year end, I will recognize 942,594 minus 47,130. That is at the end of the year. Because when you depreciate, you subtract to get the carrying amount. Will we divide by 25 if the 5 years were extended? No. On initial recognition, we divide by 20. But if it was extended, still. But we have what we call a lease modification. We are going to discuss what we call lease modification. But on initial recognition, we are just going to divide by 20 like that. On initial, that is on before extension, we divide by 20. Now that extension, we call it lease modification. We are going to discuss how you carry out lease modification in our subsequent discussions. 895 for 60 equals to 895 for 60. That is what I report on at the year end on subsequent recognition, subsequent measurement. At the year end, my right of use in my balance sheet, I will report 895 because I take the initial recognition minus depreciation. We depreciate that asset. Then, any question as we move on? Any question? Before we go to subsequent measurement of the lease liability. Subsequent measurement of the lease liability. Subsequent measurement of the lease liability. Subsequent measurement of the lease liability, subsequent measurement of the lease liability. Therefore, subsequent measurement of lease liability, subsequent measurement of the lease liability. This one we said we carried at amortized cost. Amortization schedule. And we are only going to prepare the amortization for 1 year, not 20 years. We are not doing it for 20 years. Correct, 464. Thank you very much. 464. Thank you very much. 464. 895, 464. Thank you very much. 464. Thank you very much. Therefore, here, amortization schedule we are preparing only for 1 year. For 1 year. Therefore, I say year, principal balance, that is the original lease liability, principal balance. Because payments are made at the end of the year, I bring interest, which is 6%, Then I bring the installment, then balance carried down. We are preparing for only 2 years, therefore, don't make it too long. We are only preparing for 2 years. Don't make it too long. Don't waste your book, we need it. Amortization. Therefore, year one, our principal balance is 917, 594. 594 like that, our principal balance, 917, 594. Therefore, the interest of 6%, we charge it on this one. The interest of 6%, because payments are made in arrears. We charge it on this. Then we pay 80,000. 80 is constant every year. That is what we are paying as our annual payment. Therefore, interest 6%, implicit interest rate, we charge it on principal balance. What will be our interest? What will be our interest before we end our class? 55,056. 55,056. Thank you very much. 55,056. 6% of this opening balance. This one we charge on the opening balance. Then, how do we get the balance at the end? I will take the principal balance plus the interest minus the installment I'm paying. 892,650. 892,650. 892,650. 892,650. That is my balance carried down. But I said, examiner may want that 1 year. But I said, and I repeat, I said, if payments are made in arrears, always prepare for 2 years. Always prepare for 2 years. Therefore, we call for year 2. Year 2 now, this is my principal balance, 892,650. Interest we charge on the this balance. Interest, this one we charge on this balance. We charge interest on this. Then installment is 80,000. This one is constant all the years. It is constant. 53,559. 53,559. 53,559. Then you give me the balance at the end. 866,209. 866,209. That is the balance at the end. Now, let's prepare the financial statement extracts. Because examiner will always want you to prepare financial statement extracts. This one is not yet. Therefore, we prepare a financial statement extract. Financial statement extracts. Extracts means what goes to our financial statement. What goes to the financial statement? Let's begin with profit and loss. Profit and loss statement. What goes to profit and loss? Number one, we have depreciation. depreciation. Number one, depreciation, which was 47,130, depreciation. Then interest, number two. Interest, number two is interest, which will be 50, or finance cost. We call it finance cost. Finance cost or interest, which will be 55,056 for that year one. That is what we take to the profit or loss from that lease. That is what we take to profit or loss in that lease. Then we go to balance sheet extract. Balance sheet extract. What goes to the balance sheet? What goes to the balance sheet? What goes to the balance sheet? Balance sheet, I'm taking there number A under non-current liability, non-current assets. Non-current assets. Non-current assets, under non-current assets, I have the right of use. The right of use from that asset, which was 942. I removed my figure. It was 8 something. It was 8 something. I can check here. It was 8 something. It was 892,650, I think. 892,650. Was it 890? No. Our right of use, ROU, right of use, what was the figure? After subtracting 895,464. 895,464. That is what goes to under non-current assets as right of use. And you don't say ROU, you say right of use. You don't say ROU, you say right of use, because in the standard there's no ROU. Therefore, an examiner will just fail you for just saying ROU, which is not recommended. Then I go under financed by. Financed by section. Financed by section, where I have non-current liability. Non-current liability. Non-current liability here, I have lease liability. Lease liability. Now, I said that under if payments are made at the end of the year, you prepare for 2 years. The one for year 2 will be the liability for year 1 and current liability for year 1. Therefore, this one will be 866,209 for year 1. The non-current liability for year 1. Non-current liability for year 1. Then the current liability will be the difference between these two. Therefore, I say current liability. Current liability. Current liability, I take lease, I say lease liability. Lease liability, which will be 892,650 minus 866. 866. You subtract 866. ROU 942. No, ROU we subtracted depreciation. Remember, we depreciate the asset. Therefore, we take after the carrying amount. 942 was the cost, initial recognition, but subsequent, we subtract depreciation. We subtract depreciation. Depreciation was 47,130. Mwalimu, you said balance carried down for year 1 is non-current liability. That is in if payments are made in advance. But if payments are made in arrears, I said you prepare for 2 years. Kindly, you prepare for 2 years. The one for year 2 is the non-current liability. And now the difference between year 1 and 2 is the current liability. Is the current liability. How comes this liability is not 892,650 in non-current liability? That is what I'm explaining. If payments are made, that's according to IFRS 16. When we go to IFRS 9, you don't separate IFRS 9. But in IFRS 16, you separate between the current liability and the non-current liability. How do you separate? If payments are made in arrears, I will repeat again. If payments are made in arrears, you prepare the schedule. Examiner wanted year 1, you add year 2. If he wanted year 3, you add year 4. If he wanted year 5, you add year 6. So that the one for the year 2 will be the non-current liability. That's what I'm explaining. Then the difference between year 1 and 2, that will be the current liability. But if payments are made in advance, listen very carefully. If payments are made in advance, examiner wanted year 1, you prepare for that year 1. Then the installment, like this installment, becomes the current liability. And the balance at the end becomes the non-current liability if payments are made in advance. In our case, payments are made in arrears. In our case, therefore, we prepare for 2 years. Even if the examiner wanted year 1, you prepare for the second year. That's what we are saying. Like in this one now, we take the difference between year 1 and 2 becomes the current liability. What is the difference? What is the difference, Joanne, year 1 and 2? The difference. We need another example for payment made in advance. Thank you very much. We shall do it. That is 26,441. 26,441. 26,441. In our next question, we shall be doing where payments are made in advance. Where payments are made in advance. In our next episode, in our next discussion, we shall be doing lease when payments are made in advance, so that we remove all this. But remember, in a lease, what we are interested in, what are we going to prepare to report? This is what we are interested in. The how you are doing it, we are not interested in. Don't think that when you are doing the amortization now, you are